Good afternoon, everyone. Thank you for the opportunity for me to be here and to moderate this panel. We have a good mix of fellow panel members from the industry who have a good experience in founding lending companies for financial needs, for SMEs, and for other corporates and customers. The topic for today is how Buy Now Pay Later is going to solve MSME working capital needs. I would like to start, if we can open up by talking about how BNPL overall is impacting the country in terms of how is it different for retail customers versus MSMEs. And maybe you can start by giving your views, introducing yourself and giving an opening statement, and then we can take it from there. So Anubhav, if you would please share your views.
Yeah, thanks everyone. So hi, this is Anubhav, co-founder of Rupify. So we only operate in the MSME world. So let me start with some background about how BNPL is changing and where does India stand in that respect. So I think on the consumer side, in fintech, especially in lending, India has caught up with the rest of the world a few years down the line. We've had consumer lending fintechs, we've had consumer payments, which has recently grown much faster than anybody. On the BNPL side also, there were large companies that were built outside India, especially in consumer space, and then India has had some very successful models. On SME side, I think we've taken a lead, if I can say that, because Buy Now Pay Later is just a term that's being used. SME working capital financing has been going on for decades. To give it a flavor of Buy Now Pay Later essentially helps us improve customer experience, because Buy Now Pay Later has been known to be associated with fast transaction, instant approval, short credit limits which are for smaller tenure but flexible payment options. They don't have too much documentation attached in terms of monthly EMIs, pre-closure charges, and many other friction points. So I normally would associate BNPL with low friction, a very good customer experience, and mostly a completely digital journey. I mean, in fact, if you see in India, Bajaj Finance is a tremendous example, which has been doing this for a long period of time, and even their approval happens within seconds, not minutes. So BNPL is a way for us to promote credit penetration in the economy, and in consumer world, I think that's been going well. In the SME side, what has happened with companies like us and some of our fellow panelists also have been doing it, is we've tried to replicate that experience, which is consumer grade experience as we call it, on the MSME side. The questions we've always asked ourselves that why is SME lending so difficult? Why is underwriting an SME so difficult? And those are the questions that we've tried to answer by saying that working capital financing, invoice discounting have existed for ages. Essentially, they only help a small business like a retailer buy their goods today, procure them, have that inventory and sell it in the market. And that's the period for which he needs working capital. He's buying today, he's paying for it later. If we give him that flexibility, that is essentially the working capital solution he wants. So BNPL has existed in different avatars. I think it's all about now getting and using all the digital rails that we've built over the last few years to give it that consumer grade experience.
Thanks, Anubhav. Thanks for your comments, opening comments. Very, very interesting. One point I just caught on to is improving the overall experience of giving the loan or the BNPL to the customer. Manish, if I may come to you and ask you what has been your experience in this overall BNPL space for MSMEs, but also if you can talk about the experience part of it, of giving the MSME or SME the working capital finance or the loan. Is it really changed or improved from the traditional way it was being given with so much documentation and so much things? So I just want your experience. How do you see it?
Sure. My name is Manish. I'm founder and CEO of Credex. Now back to your question. Of course, a lot of things has changed, right? Fundamentally, every credit is buy now, pay later. Whether it's you do it on consumer business side, you are buying something now and you are changing something, paying it later. On consumer side, mostly the buy now pay later is associated with what I call is an aspirational product, which means that let's say my salary is 10,000 rupees, but I want to buy an iPhone. I don't have the means. It's an aspirational product for me. Can I buy it, right? I can wants to pay 1,000 every month for next 20 years, right? So that's become an aspirational product. For MSMEs or for businesses, it's not a aspirational, it's more of a survival product. And the problem is the inventory churn out ratio and inventory turnover ratio, right? So I'm not the, as a business owner, I'm not the end consumer of a product. For that matter, I have to store a product into my inventory and then I have to sell it further, right? So by default, there is a time for me to sell this product. And for that, I need the working capital, or I need the credit to do this thing. Now, typically, if you see what happens in normal, how you work is, let's say there is a big brand. Now, let's say you are a distributor of that big brand, so you buy from that brand. Now, brand insists you to pay on cash, right? So you're paying on cash. Now, at the other end of the spectrum, you have retailer who says, I don't care who your brand is, just put the stuff. If I sell, I will pay you the money, right? So you are giving credit to here, you are not giving credit here, getting it credit here. So fundamentally, the overall role of distributor is basically to provide the credit. Now, if you are providing them a credit, you're solving a big problem. Now, let's come to the buy now, pay later. Now, how it's changing is fundamentally BNPL is nothing but trying to give a payment experience on a credit platform, right? So payment experience is you go, you do a checkout, and immediately something happened, right? You purchased, done, right? Credit, you go to the bank, you furnish lots of documents, it takes months and months, then you get an OD or a CC limit, and then you are doing it, right? But I am not interested in OD and CC limit. Let's say I am a transactional owner, I am a business owner who wants to only deal with transactions, right? So I buy something, I want to pay immediately, get a credit, and as soon as I get the money back, I pay it off, done, dusted, right? So this needs to come from there, right? So what I feel is between lending and between payment, there is another step or another field that called trade or supply chain, right? So that is where it sits between payment and between your traditional lending piece. So if you can give a payment experience, which is fundamentally a checkout experience to somebody, then it's like a win-win. Now, how it has changed a lot, right? So you look at on the TREDS side, right? Now, TREDS is giving literally democratize the entire lending piece of it. Now, unheard of in India, but fundamentally there are MSMEs who are getting at a rate of 4.5% to 5% on TREDS platform, right? The question is, can you create the same for the downstream of supply chain, which is a distributor dealer option? And if you can underwrite it, why not? I understand because of the MSME and there are multiple data points, underwriting is tough, but the problem is tough. That's why you need people to solve it, right? If it is an easy problem, you don't need people to solve it. So I think there are a lot of digitization has happened, and there is a lot more is going to happen. But yes, it's fundamentally how instantaneously you can provide a credit to any owners.
Got it. Thanks, Manish. Thanks for sharing your views. Pankaj, if I may come to you, again, the same question on how BNPL is changing the landscape for MSMEs, but also one point which Manish spoke about, the co-opting of payments and lending, right? Because a lot of data that is being generated for these MSMEs could potentially be through payment transactions, and you use that as an underwriting, what Manish was referring to. So I just want to understand that a bit more, and I know that few large fintechs like BharatPe, etc., are doing it, but I want your experience in terms of what you have been seeing in Bank Bazaar.
Yeah, so I think fundamentally, right, in the country that we exist today, I think SME, I would say, if we are talking about 5 trillion economy, is the backbone in terms of how it has to be built. Today, the data says that about 29% of the GDP comes from an SME, right? That's a broad number, and about 50% exports is done through SME. So this sector, what we have seen in the last 2 years, fundamentally a change has happened. So what are the changes? Like technology and data combined together is an experience. So the moment you have technology and data put together, this will give you an experience. So if you don't have any of these variables, you'll not get an experience. So what has transformed in the country is that as a platform, we have seen consumer lending has changed drastically. BNPL at a consumer side or BNPL at a SME side. For me, it's broadly interchangeable in terms of how it works, right? From a second is important is the credit awareness of consumers have changed. The look at the credit scores that you look at in the country, it's millions and millions of credit scores being taken up. So I think fundamentally everybody is trying to build their own credentials, right? When I was in MasterCard for 6-7 years, the only fight that we used to do is fight against cash. And I think that's phenomenally the objective of how these landscapes are changing. It's not about, and India is an economy, right? Today, it's just booming. Now, what will change? For example, now account aggregator coming in. For example, now GSTN coming into all these operations. I can underwrite a consumer based on data from source. And to be specific, I think the public goods in India, right, as a digital ecosystem has built in the last 2.5, 3 years, are coming in, account aggregator frameworks getting in, banks coming up, the KYCs, consumer experience is different from what it was 5 years back. So all that put together in the last 2-3 years is going to augment this growth significantly. And this is where the big opportunity for even SME sector is, right? BNPL is one product that I would say in the entire concept of the things. If I have a BNPL, maybe I take up 60,000-70,000 loans, equate into 6 EMIs. I don't have to deploy that capital into my working capital. I can just move it with an EMI and I can run without doing anything else. So you save so much. So today if I get 50,000, if I repay it back, I will get 75,000. If I repay it after 3 months, I'll get 100,000. So this is how the concept of building a book works for a BNPL product as well. And it creates your profile to the level where you can ask for further. We have to pay it on time on equated EMIs, what we agree. Second, you get an interest-free stuff, which is like a consumer obviously is aware of that fact. But so awareness, paying on time, I think are the two major critical things. For experience, obviously, every digital platform that operates, right? The race is about experience, the race is of transactions, how fast you can deliver with a seamless experience, I would say. And I think that's doing pretty well for the country. I think thanks to the Indian ecosystem, and to put to a point also here, globally, if you look at, right, the fact is that the public goods are not available free globally. You have to pay.
Yes.
In the Indian ecosystem, you don't have to pay. It's such a big thing which has happened the last 2.5 years. With video KYC coming in, CKYC, eKYCs, it's all on source, right? So you will see the portfolio, what SME or consumer lending was maybe 10 years, 15 years back, you'll see a significant shift because it's all from source now. And we will come to further questions, I'll elaborate some of the techniques the banks, the fintechs, the NBFCs have developed to make sure that, we get the right consumer, both from an SME standpoint or from a retail consumer standpoint.
Great. Thanks a lot, Pankaj. Thanks for sharing your views. I wanted to move on to the next segment. We have been seeing fintechs like yourself globally, right, who are in the BNPL space for customers as well as for MSMEs. Unfortunately, they haven't been doing too well in the last 1.5 years because of various reasons. They've had to take a lot of hits or losses on their P&L and balance sheets. So I just wanted to understand from three of you, as you three are founders or CXOs of your companies, are we seeing a similar trend in India? Are we having any stress on the loans, or is it like business is good, business is booming? And see, for me, when I see BNPL, I see two main factors. One is underwriting, as you rightly said, and second is the collections, how strong we are in collections. If we are not good at these two, the business is at risk, right, at some point. So maybe Anubhav, if you want to give your views of, are we seeing that stress here? What is your experience? And if you can also talk it at an overall industry level for the country.
Sure. So I think for any product, whether it's BNPL, whether it's on consumer side or SME side, the stress essentially comes in when the overall leverage of the borrowing entity goes beyond a level that they can sustain. So the West is a classic example where the credit penetration has already crossed 100% in certain countries. An average consumer in the US holds like 10 to 12 credit cards in their wallet. In India, that number is abysmally small. So I think what we need to also look at is how much credit penetration has happened in India. Has it happened only in certain pockets which are now getting overloaded and over leveraged versus some segments which are completely under penetrated and not served? On the SME side, I think the situation looks much better for both the reasons that you mentioned. First is, when we talk about BNPL for an SME, it's mostly a closed loop end-use defined product. So while for a consumer who's taking BNPL to buy, let's say an iPhone, it's, as Manish pointed out, it's aspirational. He doesn't have 1 lakh rupees disposable today, but he can definitely arrange for 10,000 rupees every month from his savings and do that. It's still a stress on his savings, but that aspiration is so strong that he wants to do it. For an SME, it's only about managing cash flows. I'm buying 20,000 rupees inventory. I am going to sell that in the next 2 weeks. I just need to plug in that working capital. So I know exactly the end use of that capital. I know that it has been used for bread and butter business. And if he's buying inventory from that X amount of money, which is 20K, 50K, even couple of lakhs, what is the SME really going to do with it? He's going to stock it, sell it, and then again use that money to grow. So it's essentially, from an underwriting standpoint, it's much safer because it's based on historical data and it's purely for a certain end use. On the collections front also, there is more comfort because how do companies like us really go about collections? The underwriting is based on the relationship that this small business or a retailer has with a distributor or with the brand. If he doesn't pay for some reason on time, there is always a stop supply. There is always a control on the receivables. So invariably, there is a chance for this payment to come back. While you may have to still deploy collections teams, you'll have to do multi-channel collections. You may even want to have a feet on street, but the kind of collections effort a working capital kind of a product like this, for example, would involve, would be much lower compared to an end-use agnostic, discretionary, aspirational product like consumer BNPL.
Perfect. Thanks a lot, Anubhav. Manish, coming to you, similar to the same question, what are we seeing in the industry today from a company perspective for fintechs? But I also wanted to ask you on the product side, has there been any innovation recently in this? Like all of you spoke about BNPL has always been there. It's just digitizing right now, and we are trying to offer a convenient way to SMEs to get the loan, right? But has there been any innovation? One of the things that I heard is that, when companies like yourself or banks or NBFCs are giving these SMEs a loan, right, they don't want them to play that money for their other requirements, because sometimes it is also given in the name of the individual proprietor or the founder of that small kirana store or whatever the SME is there. So my question is that sometimes it happens that they don't give it directly to them, they give it to the producer or the manufacturer or the supplier of those goods which he is buying to stock at his store or whatever is a requirement, and the invoices is generated and then directly the payment is made. So in your experience, have you seen any such innovation in the space? What are the new things that are happening? What is the future like? If you can just throw some light on the product side of it, it
Sure.
would be great.
So let me start with the overall, you said how MSME sentiments are. So in the first, I think immediately after COVID, yes, there was a lot of stress that was in the overall sector was. The reason was also pretty much knee-jerk reaction, because everybody was trying to just sit on the cash. Nobody knows what's going to happen. So, normal, just sit on the cash and be happy with it. From last 1 year, we are seeing a lot of green shoots coming up. A lot of companies are coming up who are doing extremely well. Now, how collections and everything related to it, I believe fundamentally whether it's a consumer or business run by humans, and humans are run by human psychology. If you change the behavior of humans, it's going to impact you, whether it's on consumer side or on business side. Now, somebody does not deserve an iPhone and you are giving him a 1 lakh rupees iPhone, you are changing fundamentally the behavior of it. So whether it's India, whether penetration is there, not penetration is there, I believe that you are going to see a lot of stress, right? Because you have changed his behavior. He was supposed to use maybe a Motorola phone, and now you are asking him to use an iPhone, right? It's not necessary for him. Similarly, even on the business side, there is a lot of exuberance of business owners that happens, which means that I'm always optimistic about my business. He is also. Every business owner is always optimistic. This is our fundamental role, to be optimistic about business. Now, in this optimism, if I started taking more and more and more, right, that is what happens is when I keep on taking credit and I don't know how to use it or how to give it back, right? So that is where when your exuberance even on the business side leads to a particular scenario where you are not unable to give the money back to it. So if you change any consumer behavior, whether it's any human's behavior, there is going to be NPS, there is going to be a defaults that is going to happen. Now, coming back to the product side of it, there are a lot of changes in the product side that has happened. I mean, what Pankaj has picked up in terms of, and what you have also spoke about, there's a lot of what we call is nowadays a cash flow based underwriting, right? So initially or earlier, banks are asking for balance sheet, right? They are asking balance sheet, give me balance sheet, I want to see you are profitable, not profitable, blah, 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 right? Now, most of the companies or lenders is going to ask you for a bank statement and see that how your cash flow is coming up, right? The GST, right? So how much your GST is filing, right? All those details are coming up. So this detail is what you are saying is a cash flow based underwriting. So balance sheet, as of now, if I look into somebody's balance sheet, it's 1.5 years old. So I'm not going to get anything out of it, right? So, but if I look into the cash flow, I can get a lot of things out of it. Just before this session, this one, I was standing there and somebody was asking what is the different financing option for EV, right? So one EV options that is coming up is revenue-based financing, right? Which is nothing but fundamentally based upon your cash flow. If your cash flow, I can forecast your cash flow, and 1 year I can see that you are going to grow by 200%, then can I, discount that cash flow and give you the money right now, right? So a lot of new innovations are coming up in product side, and a lot of even buy now, pay later, what has been unheard of is basically now we are able to disburse, not sanction, but disburse the loan in 5 minutes for business owners, right? So this is all possible because there's a lot of digital connection that has happened. Data, fundamentally, most of the lenders are not asking for data. Yes, there are a lot of PSU lenders who are still asking for paper documents, but a lot of times you don't require that. Now, you also touch base on something where you say that I don't want to give the money to you, but to give to the, that's came from the what RBI says is the end users of loan, right? So you always try to say, okay, what are you taking the loan for? You are taking a loan for home loan. Okay, I will give you to the builder. You are taking the loan for a machinery loan. I will give it to the. So one aspect of risk is always is that if you're not giving the money to the guy, but to the end users of where it is, and you're controlling that end users, you can able to control maybe the NPAs a little bit. But personal view, I still feel that there are better ways of doing it just rather than just controlling the end users of loan.
Thanks, Manish. Pankaj, your views on the product side, if there may be innovations, and you also spoke about in your last comment on the different kind of customers and how banks and other financial institutions are pushing you towards the right kind of customer segments. If you can also throw some light on that, that will be great.
So I think we're most important, if you look at BNPL as a concept, see in Australia did very well into 2020 when COVID hit, right? To the valuations, I'll tell you one example. I'll not name the company, but it's a very well-known company which was at $29 billion, which last is about 1.6 billion. So they have eroded about 93-94% of the capital, right? That's so it's as Manish rightly said, it's an exuberance, right? Somewhere if you, and I'll tell you what our learning has been, right, in Indian market context also is that when you do shortcuts on experience, to build an experience, you do shortcuts on regulations, you shoot shortcuts on consumer onboarding, it will hit us someday or tomorrow or day after. So I think the biggest learning that I would say, build the business in a step-by-step process, build it with a large vision. Most of the startups, even including all of us that we said, right, we try to look at a hyper growth, which is where the problem exists. When you have exuberance takes over factual representation, it becomes a very difficult thing. The best thing about the Indian ecosystem today is that today you have all the assets which you need to build an ecosystem. Like Manish rightly said, we have digital bank statements coming in, cash flow management coming in, account aggregator coming in. You have Karza where I can do unemployment checks for people. I have a process where I can digitally underwrite a consumer without getting into too much of data coming in on paper. So when you have these technologies available, you have onboarding with KYCs done through video KYCs, CKYCs, eKYCs, Aadhaar, all that shift, tectonic shift that we have seen in the last 2-3 years, I think being in the industry for 20 years, I have never seen. So this is a growth. If we don't do it in the next 5 years, I think we'll lag behind. As I think Anubhav rightly said, our credit to GDP ratio is about 12% right now, which is US at 60%. So if you forget the product, if it's cards, BNPL, personal loan, doesn't matter. At the end, the credit is the fulcrum to grow. You can't fund your business every time and it's still trying to grow because you have to fund it. Today, the banks, NPAs, you look at why a bank's balance sheet is so strong because NPAs have been eroded, right? People have taken out NPAs from that. People are cognizant of whom I'm lending to. If the guy is defaulting for last 15 days, I can see the data. I can say, boss, this is defaulted. 30, 60, 90, everybody is tracking it so closely. So I think the book value is important. Yeah, stress would be there in COVID. Everybody had a strike, double, your 30 plus moved into the double. 30 plus is basically was not paid within 30 days, right? It moved double. But the fact is cannot be 5x or 6x. So if you have a control mechanism with the right consumer, you know the consumer through data that this consumer is doing well, he really needs the money, give the money to the right consumer. And collections today in BNPL, you can't have a physical collections technically. The ticket size is so small that the cost of operation will not figure it out. So today, one important thing which has happened is UPI. So today, if I have a UPI embedded in the backend, right, my soft collections efficiency increases dramatically. So you have to ride on those waves of UPI to make sure collections does well. You might not have a UPI. Obviously, you don't make money on UPI when you do it, right? But the fact is that you can build a lot of ecosystem around your business to make sure that you have an efficiency built into the system to collect. So I think if credit along with collections clubbed to the right consumer, you can do anything in this country. You have such a huge consumption-driven economy we are. That's where the impact globally, you have seen the impact, and globally what India has been. So I think that's the reason. And that's where I think I'm very confident that this sector will grow dramatically. Next 6 to 12 months, I think our envisage is that account aggregator will fully be operational in 6 months. You will have data on GST and coming in 6 months where I can read the data on a machine. I can do a machine learning. The way I do offers to consumers today, I can do an offers to SME maybe 6 months down the line. If not today, that predictability analysis of this guy will take a loan in the next 6 months with the cash flow statement coming in. That will change the entire landscape the way this business has been built. You don't have to withdraw 6 months bank statement, check every transaction, then somebody in the underwriting will go, a physical infrastructure has to be built. You don't need to deal that. So I would say 2023, 22 was great for consumers. 2023, we expect from technology and data will be phenomenal tectonic shift for SMEs where our data says that about 99% still micro, right? SME, though we say SME is a very broad concept, but in India we have 99% of the consumer, the SME is micro. So the moment you shift from micro to small and small to medium, I think that's the way that every individual, every government employee who's into this industry has to track it and make sure that our percentage contribution of micro to SME has to move significantly. And credit, I think, is the bottom line where this will take to the next leap. That's our view.
Yeah, just to add actually. So I think we've been talking about experience. So when we look at experience, especially in a lending concept, we need to be watchful of two things. It can work both ways. So for example, I have a fundamental belief that bad experience leads to adverse selection. Because if let's say in a lending journey, I have too many friction points, the good guys will probably drop off. They'll be like, I can probably get a loan faster at somewhere else. So you are essentially leaving the good guys out and you are doing some kind of an adverse selection. But at the same time, if you make the experience too simple, then you are letting the bad guys also in too easily than you should ideally do. So experience is double-edged. You need to ensure that the good guys don't feel the pinch, but the bad guys don't come in. So from a product standpoint, since Mihir, you were asking, I think it's very important that when we think of experience, we just don't think of should the journey be completed in few seconds or a certain number of minutes. It's also about how do I ensure I collect the right amount of information and data with the least amount of friction, without compromising on the information I need for underwriting, but at the same time building through technology in terms of how I get that data.
Sure. Thanks, Anubhav, and thanks, Pankaj, for your views. That's great to hear. I mean, 2023, we are looking forward to see how that will revolutionize the lending industry for MSMEs and SMEs. My question, next question was more on the actual, when we look at a consumer lending, right? We say that, or a credit card business for that matter, we say that person who doesn't have CIBIL score below or above 700, we will not give a kind of credit card. Is there anything similar in your space, in the MSME lending space? are there certain customer segments that everyone wants to go after, and there are certain customer segments that may be risky and not much attention is being paid for? So maybe Manish, if you want to share your views of what you are doing.
In one word, everybody wants to go toward profitable business.
Correct.
Right? So you are rated, not rated. If you are profitable, everybody wants to lend you. It's the same as consumer civil score more than 700, right? Everybody wants to lend.
But how do we change that? I mean, as a country.
I think some changes. I think as I will try to more represent it from a risk person, right? So I think the problem which I've seen is mostly the sales guy in the lending institution. They pretty much try to understand, the risk guy doesn't, right? So maybe the use case is take the risk guy to do 5 sales and ask him to close those deals, because every business is different, every trade is different, and if you don't understand it, it's very, very difficult. You cannot have the same lenses and start saying, okay, this is the same lens I'm going to apply to everybody, right? It's not going to work. There would be a lot of traders here who is doing trading and maybe sitting at a 1 or 2% or 5% margin, right? Maybe a profitable business, but also it's a risk on that. What if the trading business goes, right? Similarly, if you started questioning every business with the saying that where are the fault points, there are always fault points in all businesses, right? You can't build like businesses so easily. Otherwise, everybody would be an entrepreneur here, right? So, but what a risk guy has to understand is, can I see the green shoots in each businesses? What are good happening in the businesses? There could be, a lot of businesses which are sitting on 40% margin, but their problem is inventory. Their inventory is just taking like 200 days to get turnover, right? It's a good business, bad business. Again, the jury is out on that, right? So I think what is necessary for is, how can I change as a lender? How can I change my risk guy to start thinking from a business perspective, rather than having a business guy think and say, yeah, it's all doable. But when it goes to the risk team, they're saying, oh, it's not doable, right? So you need to understand alternative data points. You need to understand, and I believe in businesses, all business finance is fundamentally a structured finance. You need to structure it. You need to have, I generally say that each lender needs to have a structuring desk where somebody is sitting and trying to structure the deal. Every deal is doable provided you can structure it well, right? When I started my career, and one of my boss in risk, he used to say, you have to always price your risk, right? And the only point I have a disconnect with him is that when you're after pricing the risk, if your price is too high, then it's going to lead to basically what Anubhav says, adverse selection, right? But otherwise, I think you can always structure the deal. You can always price the risk deal in a proper way.
Thanks, Manish. Thanks for your views. Pankaj, what are your views on this in terms of the customer segments? Because you didn't mention that in your last comment. You focus more on the product side. So any views on the customer segments?
So I think the problem, I'll tell you, Mayor, and it's a very honest problem, and I don't think so anybody has solved it so far, is that the good people pays the cost of bad people, right, in this lending space. So whenever I model it out, a commercial model, I will always model it out with 4, 5, 6% delinquencies coming in from that sector, which is in pricing for good consumers as well. So what Anubhav rightly said, that there is a negative selection that keeps coming in. So if I price it the way it is being priced today, you'll have to do it. If I don't price it, obviously the economics of product will not be there. It's a very big challenge that we are grappling with, and I don't think so anybody has solved it so far. What is happening now, Mayor, as I talked about cash to credit economy, right? And being from PWS, you have seen the numbers the last 5 years. You can talk about after demand, obviously there were bits, but when it comes to now a book being built, right, where I know this balance sheet, I know this P&L is like doing this, the cash flow is like this, your wide transactions are coming in. So now you're able to lend far bigger ticket size to the same consumer, which you're not able to do 5 years back. Yeah. So that's something which is changing. It's a long phenomenon. It'll take 5 to 7, 8 years of long cycles to come in and kick in. But long run, it will really benefit the entire ecosystem the moment you see this thing coming in, right? So this will change, because now what is happening, every bank, any product, if you default, right, it's a very clear mandate that normally we don't fund, right? Nobody will fund those customers. Second concept that I learned when I was in CRISIL, in terms of when we look at it, right, is there are 2 factors. One is willingness, one is ability. So willingness is something that still no algorithms or machine learning can crack, right? The ability is something we can still crack. So the ability percentage of the consumers are able to do, I can still crack. But the willingness is something that intention, this is something which is becoming a big challenge, and I'm sure with the artificial intelligence that we're trying to build in, the psychometric, whatever, model, alternate model scores we're trying to build. For example, we have Experian as our investor, and we've been talking to them that is there a way that you can model it out with your X factor data that you build in. If I transact today, I think we will be able to do it now, because with GPAs coming in, with all this consumer payment cycles coming, I know broadly this guy has this much of capability, and he's been doing it for the last few many years. So I think this 18 months, I would say, we will be able to crack that code as well in terms of how we're going to build that. And once you build that, I'm sure there is no stopping in terms of the credit, this thing. Because today, I think most of the people are sitting out here, if their ability is there to pay 100, they're still getting 30 rupees. That's the difference, and this is because everybody is risk averse in terms of taking that exposure and fund, because when the cycle hits bad, there is no way that you can collect that money back. So that's, I think, is a shift that we will see. But I'm hopeful with this technology, the data, and even the awareness of consumers. I think responsibly Indian consumers are behaving. Today, look at a street today, right? People are taking GPAs, any auto, any this thing. You can't imagine 3 years back, right? You can't say that I can give a 5 rupee to a vendor, right? But everybody, 90% of the population today is laying it. So they're going to take it up very, very significantly. All your hinterland will start growing. Your e-commerce transactions are growing. Amazons and Flipkarts of the world are growing. So I think we are very well poised for a very fast growth. We are growing, I think, in the global ecosystem, we are going the fastest, and we're still maintaining that pace. I would say we should model something like Korea, where there are a lot of stuff where, the digital payments are incentivized by governments broadly. That's the concept India has also brought in. But still, I would say we are still far from incentivizing
South Korea.
That's South Korean, not North Korea. Yeah. So I think that's where I think we are trying to figure it out. And once we get to that level, I'm sure, things will be very, very different for the country.
Perfect. Thanks a lot, Pankaj. Moving on, I wanted to discuss on the pricing and the financials part of this entire business, right, that we are all into or we are speaking about. Manish, you mentioned earlier that the interest could be as low as 4 to 5% for some of these customers. So how does it make financial sense, or what is the kind of revenue cost levers that you typically work on or operate on as an industry?
See, the benefit of trade is what I call is it's a double hook product, right? So double hook means basically there is one hook at your end and the other hook could be at your buyer or seller end, right? Now, if your buyer, let's say, is a large buyer, right, or your seller is a large buyer, then you should get benefit of it, right? How should I differentiate two companies? Both are at, like, let's say everything is same, their revenue is same, cash flow is same, everything is same. But one company is, let's say, selling it to Reliance and one company is selling it to other MSME. Why can't that company who is selling it to Reliance can be a beneficial? Or if somebody is buying it from the likes of, let's say, Adidas or Nike, why can't they get, if they are a distributor, they have a long relationship, why can't they get benefit from them, right? So the benefit of a business or a B2B trades is fundamentally that if you can expose your second side, which is a bigger side, you can get the benefit of that, right? So when I said 4.5%, 5%, what is happening is a lot of MSMEs are going to trades. They are saying, hey, I'm, by the way, selling it to, let's say, Tatas, and any bankers are ready to willingly coming and saying, yeah, I'm ready to underwrite it at a 4.5%, 5%. The reason why it's a 90 days credit, so fundamentally it's anyhow less risky, and then on top of that, it's a counterparty risk is much lower, right? So this is just one extreme of the side, but overall, the benefit of all this double hook is what is happening is the more and more lenders are getting exposed to it, and then they are recognizing it. And if they're not recognizing it, believe me, the borrowers are themselves saying that, boss, this is the other side of it, right? So I need a benefit of that other side. And that is where you are getting somewhere where if your normal unsecured cost of fund is, let's say, 15, 16%, but you are doing a trade with a larger counterparty, then you can say that, hey, the larger counterparty cost of fund could be, let's say, 5%, give me something in between, right? So you are getting benefited if you're selling it to larger guy, right? The thesis from the lender side is also that if I am, let's say, a Reliance or a Tata, I also want my supply chain or my entire thing to be solid, right? I don't want a fly-by-night operator. So I am doing a lot of due diligence to find it out who is this guy, right? Is he capable? Can he support me? All those things, right? So I fundamentally offloaded a bigger part of my risk onto the vendor or distributor selection process of the larger companies, right? If they are trusting him, I can trust him, right? There's no harm on that. So that is what a lot of those things are happening into the world, and that is where the prices are moving more favorable to the borrower. I know not say it's more favorable to us or to the lender, but definitely more favorable to the buyer. It is what mostly you can say is democratizing the credit means.
Perfect. Thanks, Manish. Anubhav, what are your views on the pricing or the financials, the revenue cost implications? How does one make money as a fintech in this space?
Yeah, so I think there are two theses that operate in the fintech space. One is how do you monetize the customer once you have acquired the customer? So which product do you use for customer acquisition? A lot of companies, they rely on their customer acquisition product to be such that it's a mass product. It's a low friction, quick to market product. They may be negative on the unit economics on that product, but the potential to cross-sell multiple products in the lifetime of the customer is much higher. I think in the MSME world, most players look at it differently, because the repeat rate of an MSME using a working capital or any kind of a lending product is much higher. So if you continue to bleed money on, let's say, an overdraft kind of a product or a credit line product like a BNPL, then over the lifetime there is a lot to be recovered. So fundamentally, I think in the MSME space, there are only two costs one needs to look at. One is the cost of credit, which is both credit loss and collections cost, and the other is cost of capital. Considering that technology is being used and operating expense and CAC is very low, if you can balance these two, then even for a thin margin business, because most of working capital products are 30 days, in fact 15 days is also something that we do, and go up to 90 days. So in a short period product, obviously, you're not building the book much faster, it's fast churning book. Second, the margins obviously become lower because the vintage is much smaller. The tenures are much shorter. So these kind of businesses rely on high volume, right? And to do high volume, you need many more economies in terms of all your processes. So that is where technology comes even more powerful, that if I have to build a 500 crore monthly business, then I need to have extremely low costs when it comes to operating these models. So from a financial standpoint, even a 50 bips difference in pricing creates a big difference, right? For a customer taking a personal loan, like me, 11.5 versus 12%, we don't normally care, right? There are very few customers who will go and negotiate with their bank for a 50 bips rate on a consumer loan, right? They would rather look at it that, can I reduce the hurdle of going 5 times to the bank, and can I solve this through an experience where I'm saving that cost from my side. On the SME side, every single price point is very critical, because if I talk about retailers, they are anyway low margin businesses. In FMCG, small kirana shops that have anywhere between 3 to 8% margin depending on different SKUs. For them, a 0.5% pricing makes a lot of difference. So that's where I think it becomes very important for fintechs that operate in MSME space. They are very well sensitive to the end borrower pricing, and they have to accordingly back calculate everything, right from how do they optimize their cost of capital, how do they ensure that they use some of these relationships that Pankaj and Manish talked about, that do I have a SME which has a relationship with an anchor, like a large corporate, and based on that, my risk goes down, my collections effort goes down, can I pass that on to the borrower? Because all of these are critical in your financials.
Thanks, Anubhav. Pankaj, I wanted to ask you, in terms of the product, we did speak about the tenure of the product, right? Manish, Anubhav said sometimes it can be 15 days, 30 days. You also mentioned it could be 12 months, right? So what is the typical duration of the product for a BNPL, for a MSME or SME? Is there like any standard product, or does it vary depending on the company or the appetite or the customer itself?
So I think it varies, but broadly we have seen about 1 to 3 months is the broader range in which the most of these products will revolve. And I'll tell you, in the BNPL concept, the most important thing is merchant subvention. So you, as Anubhav and Manish rightly said, this business is tricky for a lender. It's not going to make money. Let's be honest, it's not going to make money. I'll tell you why. See, one, it makes money when your cost of funds are like abysmally low. In 2020, the Indian context cost of funds was, I think, lowest in the last 15 years, I would say. Now every month, every quarter, MPC is meeting and the rates are getting this thing. So there is a delta in which you can operate, right? You have interest-free credit. You have 4x, 5x of GNPS coming into loading onto it. You don't have 60, 70%. So if you have a card business, if you look at it, you have 60, 70% interest you make, right? And balance is the other income. So if I squeeze it and say that I'll just make 30% and I'll give it to consumers with that kind of, vintage, it's difficult to make a business case out of it at a standalone product basis. What Anubhav rightly said, see, look at the banks that they've done, right? How they build this business is like product holding ratios, right? If I do one product, I have to do 5 products. That's where HDFC scored with most of the other banks in the country. They were able to cross-sell to the existing consumer with 4 or 5 or 6 products at the same portfolio. So I think till that time you're not able to crack that code. It's a more execution-based phenomena. You have to execute relentlessly years and years to make sure that this customer is profitable. If you do it once and you say that I'll make money on this product, you'll not be able to do it. So this is where I think our learning has been, and fundamentally it's very clear. When the cycles will go up, you will get bankrupt. That's the fact of life. Because you will not be able to sustain that kind of cash flow that you need to fund this kind of a business, right? And everybody in India understood this, and that's where you have seen the regulation coming into picture. Don't do a camouflage businesses. It's a very hardcore underlying fact that has come. So I would say, from a product concept, I think this is important to understand. If you have a very right mix of merchant subvention coming into picture, along with the product, you can give a great experience. But if that's not happening in a standalone and trying to build it, it'll be, I would say, very, very difficult to do it right now. 18 months down the line, and I was talking about when technology comes in, the cost of delivery will become, I would say, 1/4 of what it is today. At that time, you will see a significant change the way this business. I don't have to charge, 2 or 3% on an annualized basis in that case. Because see, today, merchant subvention, you take 4, 5%, 7, 8%, you can do it. So technically, zero EMI that comes in for those consumers. So I'm very happy to take an iPhone with the equated EMIs for next 3 months, 6 months, 12 months, or a laptop for my SME sectors where I can give it to people. But it has to be as good as what I'm taking it. The catch, I would say, for consumers is that the price gets built in. So that 4% is not free. Nothing comes free. That price, if I do and pay a cash payment, I might get at a lesser price also. So I think that economics, consumers are aware. But if I don't have that 50,000 rupees to pay for a laptop, I'm fine to pay 5,000 rupees for next 10 months. That's a flexibility. Flexibility always will have a cost. Convenience will have a cost. So you have to think through it that I'm good to do this without taking a discount that you take it. And Indian markets is full of discounts, right? The moment you talk about, it's all discounting that you look at it. So I think framework is there. Products are getting innovated. Every quarter, I would say some innovations are happening, but some restrictions also coming in, In fact, if you look at networks like Master, Visa, they develop products with a prepaid where you can do it just in time. The limit can reside on a card. If I transact at that time, only the limit will be used. So there was a technology shift that has happened, and you can build those prepaid GPR cards and you can swipe it like a buy now, pay later kind of a concept, and it will be built into EMIs. So what happened is that credit card also started emulating the same. I'll give it a 12%. Let's build into an EMIs for next 12 months. So HDFCs and all the top banks have their own smart buys of the world where you can do and transact and convert into EMIs. So the concept of EMIs is brilliant as far as you are disciplined to play it on a monthly basis. The moment you don't pay it back, you will see a huge runoff which will happen on your credit profile. So that's, I think, consumers should be very much aware. Whenever they're taking it, don't default. And multiple BNPLs can be created. That's a catch. So if I create 5, 6 multiple, I have to remember every cycle where I have to pay. If one of the cycle gets bounced, my credit score will get impacted. So it's a complicated thing, but convenience has a complication. if you don't do it right.
Sure. Thanks, Pankaj. But I was just thinking when you were speaking, why not have a differentiated product for MSME, like how we have a credit card for for an individual? Can we think about a credit card kind of product for a MSME where we give them that card? I'm just saying, akin to what BNPL is for them. Why not give a credit card? And because you spoke about, the margins are not that much, you can't make so much money isolated. Credit card is a highly profitable product for any bank or financial institution. Why not give that to the customer, to the MSME, and say use it for your purchases, for your transactions, for working capital needs, etc. You earn interchange, you earn float, you earn interest income, you earn fee income. So there are so many lines of income that you can earn. Is there a possibility? Has anyone thought about it? I know the underwriting is still a challenge, will still be a challenge in some sense.
It's happening, but fundamentally in the B2B side, the commercial card side, it's still only to T&E expenditure and employee expenditure. The larger, which is the T&E and employee, is like less than 1% of the overall business spend, right? When you go to the larger business spend, which is like vendor payment, right, and any kind of other larger payment, the problem is the other side also understand that they have to take the MDR, right?
Yeah.
It's the larger question
There
on the
can be
B2B.
differentiated MDR also. Small
Yes,
letter,
so
lesser
there
letter.
are some works going on in terms of variable interchange also, but it's still, I would say that, who will build the CAD of MDR? So till the kind of time it's not getting built.
Like UPI
See,
did,
for
make it free.
consumer, it doesn't matter. They're not taking up the charge, right? The merchant is taking up the charge because they have been prepped
Yeah.
into thinking that, boss, it's going to
Increase
increase their
business.
sales, right? But for the businesses, it's become tougher, right? So buy now, pay later is fundamentally a sort of effort towards that, where you're saying that if I can give you at point of sale, if I can give you a credit, can you buy more, right? So we have seen, yes, buying is more, the cart value is increasing, right? More new customers are coming. But now, buy now, pay later is still coming at a lesser cost than MDR. MDR is like literally 2% for 30 days, right? So it's much higher than buy now, right? Until unless a variable interchange comes up and it's become a main instrument, it's still very tough to get acceptance on the B2B payment for credit cards.
Thanks a lot. Anubhav, in your view, what has been the relationship between companies like yourselves, fintechs and banks? Is there like a competition? I'm saying for the same SME credit segment, right? Like traditionally, obviously, MSMEs used to take it from your local kind of money lenders or whatever because they didn't have access to formal credit. But if they're getting into the formal credit space, is there like a competition or is there like a collaboration with banks specifically, I'm asking, or even larger NBFCs? So how do you see that playing out going forward?
Sure. So I think both on the consumer as well as MSME side, it's more been collaborative since fintechs started booming in India. But especially on the MSME side, we've seen more rather reliance on fintechs when it comes to using technology and alternate data, because SME underwriting has always been challenging. Because in India, a lot of businesses use cash for a majority part of their operations. So it's difficult to estimate their true financial health. Their financial statements don't reflect their correct turnover. Their income tax documents are not completely updated. So how do you really go about solving for underwriting? Bank statements will not even have those transactions. Payments is one thing which has come as a alternative to help underwrite, because you can see cash flow information. And those payments related solutions are all being brought up by fintechs. So what banks have realized is that if they have to go deeper, and especially for smaller businesses, like as Pankaj said, 90%, 95% plus are micro, the operating cost of acquiring that SME for a bank is something they can't even imagine.
Will not make sense.
It
for
will
them.
never be something, at least for the next 5 years, they will not be able to profitably onboard that customer. So they rely on fintechs, not just from an underwriting standpoint, but from a low cost of acquisition standpoint also. We've seen in our experience also, banks have come forward accepting that this is the best model where they collaborate with fintechs. Of course, there are, from a commercial standpoint, different business models in which they work. But I think most banks are very positively working with fintechs on collaborating. especially I think with the PSL related
priority
targets
sector
that
lending,
they
yeah.
have, it's very important for them to go after some of these segments which they are not able to themselves achieve. So they also look up to fintechs to help onboard some of these priority sectors onto their books. But outside that as well, I think they clearly realize the gap that fintechs come and fill in. On consumer side, the trend is slightly different. I think for a salaried consumer, the banks also know that ultimately credit bureau plus bank statement solves 90% of the problem. So, and they are able to get that digitally today. Even a bank has digital KYC, digital onboarding, they can check bureau in seconds, they can scan a bank statement in seconds. So for a personal loan, I mean, all salaried individuals have a 10, 15, 20 lakh personal loan instant approval from their salaried bank account. But when it comes to SMEs, the banker is also not in a position to give them a complete picture. So I think fintechs come in quite strongly there.
Sure. Thanks, Anubhav. Pankaj, any views from yourself on the collaboration between bank?
So I think I'll agree with Anubhav. A few years back, we as a company also were trying, most of the companies in the startup space backed by investors trying to disrupt the market. We say we'll create a parallel bank, we'll create a digital bank, we'll create a X, Y, Z. So I think that's how every startup or every fintech person used to think 5, 6 years, 8 years back, right? But what we, and personally, I think I would say hats off to the way, regulators come in. It's very clear mandated that it has to be a collaboration. Don't try to disrupt, because the onus of this entire ecosystem, the financial sector, is still with banks. If you ask me today, I can be a fintech. I have funds coming in from investors outside India. I am still a fintech, right? My ownership is still limited to a fact of the matter. I'm giving an experience, I'm giving technology, I'm making life easy. That's it. But technically, when you talk about, risk, underlying risk, I think banks have taken that responsibility to make sure that the right consumer is being underwritten, the right consumer. Maybe their processes are still, I would say still that not that consumer friendly, but they are evolving. So I think I have to give credit to the banks how they build this franchise, and we have to admit there are challenges. They're not easy stuff when you flow money. It's a financial transaction at the end. So I think our strength is data, consumer experience, and technology.
Sure.
These three things, as all fintechs in this country should ride on. Go to the bank, collaborate with them, build their digital systems to an extent that they can service a last mile consumer, which is a problem that we have seen with banks, because I don't have a branch, I can't service. So that problem is going off. And that's where I'm so confident that next 18 months in this country, so consumer we have seen, look at the consumer, the way HDFC built a 10-second loan for existing customers. Today I can service the same new to bank customer within 20 seconds. Because that's the technology now come up, without any paper, without any data, without any physical interaction with customer. I don't meet customer. It's all technology now, right? So this was never the case last 20 years, which has happened in the last 18 months. Same thing I'm seeing in the next 18 months for SMEs, where you won't need to meet an SME. I can underwrite it in 18 months from now. That's a clear fact of life. Finance Minister himself, we were a part of some of the conferences. It's very clear that AA will be like the backbone where we'll ride. ONDCs will come, OCNs will come. You will see a significant shift the way this transaction going to happen. So I think this is happening, and we are in work in progress. Consumer is done. I think few more things will happen in the next, I would say 6 to 12 months, where we'll ride onto that bandwagon, and then I think nothing stops us from delivering that experience what you've been talking about, which is still sub-disruptive or suboptimal from SME, but the next 18 months, I'm sure 23 end, we are there. So this is one big aspect I would say, Mihir, that will change the entire scheme, the way we operate our business.
Thanks, Pankaj. Manish, any last views on the future? Pankaj has spoken about his views. What's the future for the next 12 months, 18 months for this space? What are we in for? What to watch out for? Right?
I think we need to be optimistic. I think India is doing great. I mean, whoever I met who is coming from US, they're saying that if you see that, if you feel recession is coming and the dark clouds are there, multiplied by 4x, right? That's exactly the dark clouds right now in US, right? So we can't see any dark clouds. We can still see all shiny, good sunlight here. So I think things are good here. We need to move. I think a lot of this after COVID and because of Russia-Ukraine war, there's a lot of reshoring, nearshoring, friendshoring, all those whatever terms are coming up, which is leading to a lot of supply chain is moving to India. I think we should just grab it by both hands, both legs, whatever, the entire body, and just grab it and take as much benefit as possible. There's a lot of things happening. We need to keep our ear and eyes open to understand what's there. I think there are a lot of opportunity. There are different kind of credit available in the market. I think a lot of those details are available on internet. So as a business owner, I would suggest everybody to look for it. If you have a need, I think there is a solution. So don't just think that there is not a solution in the market and it's still the traditional collateral-based ODCC limit is coming up. There are tons and tons of new innovations are coming up on products, and just reach out to friendly neighborhood lender or a fintech, and they will try to solve it for you.
Great, thanks a lot. I think it was a great panel. Thank you, Anubhav. Thank you, Manish. Thank you, Pankaj, for your views. We had a really good, interesting discussion on product, technology, future. And as you said, let's all be optimistic and go forward. Thanks a lot. Thank you for it.